Most traders think the ICT unicorn model is complicated, but it's really not. They just simply over-engineer it and miss the whole point of the model. And in reality, the unicorn model only has one real job, and that is to catch the move after the liquidity sweep, not before. So I'm not here to teach you guys about indicators, picking tops and bottoms, support and resistance. I'm just showing you guys where the market is tipping its hand to you and how you can simply take advantage of that buy model or sell model. So in this video, I'm going to be breaking down the whole ICT unicorn model in as simple as possible. So one model, one logic, one repeatable execution, so that you can actually trade the model, not just draw it on your chart. So no theory waffle, no hindsight charts, just simply how the institutions move price and how we can align with that. So we'll start off the video just by going over a couple of slides of what the actual unicorn model is, and then we'll just dive into a few chart examples. So starting off with the actual confluences of this model. So if any of these are missing, then there's simply a no trade. So step number one, we need to see a sweep. We need to see price rating obvious high or low on the higher time frame, whether that be buy side liquidity or sell side liquidity. So a swing high, buy side, swing low, sell side, simple stuff. On the higher time frame as well, because if we see a liquidity sweep on the higher time frame, it's going to have a way bigger impact on the lower time frame charts. So think 4 hour sell side liquidity getting swept in the market. Just think how the 1 minute chart will react to that higher time frame sweep. It's going to have such a clean impact on price on the lower time frames. Or it could sweep session liquidity, previous day high or low, London low, Asia low, whatever liquidity on the higher time frame, whether that be session liquidity or time based. Then number two, we need to see a displacement away from that liquidity sweep. So we need to see a strong move away. If price is moving down and it sweeps out sell side liquidity, we need to see buy side delivery displacement. So what does that mean? Price is moving down and then you get a sharp displacement to the upside. That is your displacement in terms of buy side delivery. Also, it must cause a shift in delivery. That is your market structure shift. So if a swing low gets swept, you want to see a swing high get broken to the upside. And if a swing high gets swept, think London highs, Asia highs, you want to see a simple swing low on the 1 minute chart. I'll show you guys in the examples. You want to see a swing low get broken to the downside with a displacement. So that is step number two. Step number three, we need to see a clear, visible fair value gap to confirm that displacement. So you're just simply going within the displacement leg after that market structure shift, and you're just searching for a fair value gap on the 1, 2, and maximum 3 minute chart. And then step number four, we need to see a breaker block to confirm that change in the state of delivery. Now, if you don't know what a breaker block is, I will show you when we get on the charts, but in simple terms, it's just an order block that has been invalidated. So think a bullish order block gets flipped to the downside and retests it as resistance, again, opposite for longs. And without the breaker, it's not a valid unicorn model. It would just be a simple 2022 model, but for a valid unicorn model, it must have the breaker block. And when you align the fair value gap with the breaker block, is a way more powerful, way superior model than the 2022 model. So how do you actually execute it on the chart? So number one, you need to mark out your liquidity levels. So start your day by marking out previous day high, previous day low, session liquidity, London highs, Asia lows, etc. And obvious swings, whether that be on the 15 minute, the 30 minute, the 1 hour, the 4 hour, any higher time frame works. And then step number two, after 9:30 a.m. Eastern Standard Time, which is New York time, you simply want to wait for a sweep on any of those liquidity levels, whether that be previous day high, previous day low, etc. And then you want to see the displacement away from that liquidity sweep. Also, you want to see a market structure shift be caused by the displacement leg. I'll show you a lot what that looks like in the charts. Number three, we need to mark out the fair value gap within that displacement leg and also mark the breaker block. And then your entry is simply the retrace into that zone. So whether that be into the fair value gap, into the breaker, whatever comes first and whatever is the easiest entry. Obviously, if you're looking for a buy and the breaker block comes before the fair value gap, you would just simply enter inside of the breaker block. Sometimes you can't get away with trying to enter inside of the fair value gap. Just know that sometimes you may not get filled if it is the lower entry for buys and the higher entry for shorts. And then step number 5, you're just simply targeting a pause in liquidity, specifically internal range liquidity for at least TP1. So for example, this model is based off of an external range liquidity sweep, and then you want to be targeting internal range. You want to be catching that retracement or even the reversal after the liquidity sweep on the higher time frame. Stop loss is simply going to be beyond the sweep, whether that be the high or the swing low that caused the liquidity sweep. That is going to be your more conservative stop loss. Or you could put it beyond the fair value gap. Obviously, if you put it beyond the fair value gap, it is going to be tighter risk, therefore may result in higher chances of getting stopped out before the move. And then as for targets, you're just targeting a pause in internal range liquidity first and then external range. For example, you would close 80% off at TP1, which would be internal range liquidity, and then you would just simply hold a runner for external range liquidity, and that's where you'll be closing the remainder 20% of your position. And then no chasing entries. If it doesn't tap the zone clean, the breaker block or the fair value gap, then I simply skip the trade, because is it really a valid unicorn model if it's not even going to retrace into the breaker block or the fair value gap? Okay, so now I'm going to show you guys a couple of chart examples and what this model looks like on the charts. So we're going to start with a buy example, and then I will show you guys a sell example after. And these are trades that I've actually taken personally in these live markets. Then step number 1, you want to see a sweep on buy side or sell side liquidity. So for me, the buys on this day was longs. So I was just looking for a nice and clean unicorn buy model. So first of all, sweep of buy side liquidity. Step number 2, you want to see a displacement away from that sweep, a nice sharp energetic move. That's exactly what we'll get here. Also within that displacement leg, specifically if you're looking for longs in this case, you just want to see a swing high broken to the upside, and that is your bullish market structure shift. Also within that displacement leg, you want to see your ICT bullish fair value gap, and that is what we get here. From this candle's high down to this candle's low, this is your bullish ICT fair value gap. And then lastly, you're just simply looking for your breaker block. Again, in simple terms, it's just an invalidated order block. So it would be this candle right here that gets pierced above. And then a bullish breaker block is simply a low, a high, a lower low, and then a higher high. And then the lower high to the left of it, the up close candle, it must be an up close candle. That is your breaker block right here. And notice how in this long example, the breaker block is sitting slightly above the fair value gap. So in terms of the entry, you're just going to take it at the easiest entry possible, which would be the retest of the breaker block. Stop loss would be beyond the fair value gap in this case, as it sits right next to the external low of the liquidity sweep. Also notice how, because the breaker entry came first, price didn't even give the retrace into the fair value gap. So just like I was saying before, if you did go for the fair value gap entry, or in this case the lower entry, there is less chance that you will get filled on some trades. So again, personally, what I like to do is just enter at the easiest entry first. In this case would be the bullish breaker block. And then as for targets, you just simply want to target internal range liquidity on the opposing side of the dealing range. So what do I mean by that? So if you already know the concept of premium versus discount, this will help you guys way better. But for those who don't understand, you just simply get your Fibonacci tool to get your 50% retracement level. Get it from the swing high of the dealing range down to the swing low of the liquidity sweep, and then find 50% of that dealing range. In this case would be this blue horizontal line right here. That is your 50% level. And so anything below that 50% level is a discount, anything above is a premium. So if you are buying, you want to be buying in a discount and selling in a premium. So what does that mean in this case? You want to be buying in a discount and taking profits in a premium range. Anything at or above 50% of this dealing range is fine. And so if you're just looking at the 1 minute chart, you'll immediately draw your eye to this swing high, which is right next to the 50% level. And it is fine if you want to do it that way, but personally what I like to do first is check the 15-minute and the 5-minute to check if there is any unmitigated bearish fair value gaps, because in this case we are going long. We want to be taking profits in any opposing higher time frame fair value gap. So we'll go to the 15-minute chart, and you can clearly see next to that 50% level there is a 15-minute city or 15-minute bearish gap. That is where my take profit was on this trade. Again, I'll show you guys the proof, and you can see how price just builds up and then finally hits TP. Doesn't even give the retrace to 50% of the dealing range before coming all the way back down to break even. So if you did hold this trade for in a premium of the dealing range, for example that swing high right there next to 50%, chances are you would not have taken profits in time and you would have been stopped out at break even on this trade. So it's important not just to look at the 1 minute, you also need to be checking the 5 minute, the 15-minute, even the 3 minute, just for opposing imbalances where you can potentially be taking profits. So again, I'll just do a quick rundown of what the model is. So step number 1, you want to see a liquidity sweep. Step number 2, you want to see your bullish market structure shift within the displacement leg. Price must displace, show some willingness to the upside. Step number 3, you want to see your ICT bullish fair value gap. That is what you get right here. And then last but not least, you need to see low, high, lower low, and then the higher high. And then you get your ICT bullish breaker block, which is where you're going to enter from. Stop loss is below the swing low or beyond the fair value gap. In this trade, personally, I just put it beyond the fair value gap at the low of the imbalance. And then taking profits, you simply want to be targeting the opposing side of the dealing range. So in this case, we're buying in the discount. We want to be taking profits in a premium, but there is some exceptions, obviously, that I've just showed you guys. If you go at the 15-minute or even the 5-minute, you may see some unfilled imbalances, and that is exactly where personally I take profits. So let me just repeat that again if you are confused here. If there is an unmitigated fair value gap on the higher time frame that is before the 50% level of the dealing range, I'm simply going to be taking profits within the bearish fair value gap because it is before the 50% of the dealing range, because in some cases price won't even get all the way to the other side of the dealing range. It'll just come back to internal range liquidity on the higher time frame, and specifically this higher time frame bearish gap. And yeah, that's where I did take profits on this trade. And you may be thinking, well, there is a bearish fair value gap below that one, why didn't you just take profits there? But if you get a look at where 50% is, it is literally inside of this bearish fair value gap. So I thought I would just target that one. But as soon as price retraces into this higher time frame 15-minute, that is exactly where I will be going break even on the trade. Okay, so here's another long example. So prices in a downward trend, higher highs, higher lows, whatever, sweeps out sell side liquidity. And then let's see if we get a displacement from that sell side liquidity, causing a bullish market structure shift. So a swing high broken to the upside. Okay, and that's exactly what we see right here. And this isn't just any short-term high, this is actually an intermediate term high, because it is a swing high inside of a bearish fair value gap. That is a more meaningful market structure shift whenever price breaks above a high that is inside of a bearish fair value gap. And again, for it to be a valid unicorn model, it must have a breaker. So we'll get a low, we'll get a high, a lower low, and then a higher high. So soon as price prints this higher high, you're going back in price and you're looking for your bullish ICT breaker. But notice how the down close candle is higher than the up close candle. In this case, you still want to be going for the up close candle because that is the actual invalidated order block. And also we need to see your bullish ICT fair value gap, and you get that right here. Again, in this case, the high of the breaker block comes before the high of the bullish fair value gap. So as soon as price breaks above this high and retests the breaker block, that is exactly where you will be wanting to go long. If you're just simply trying to go long inside of the fair value gap, chances are that you may not be filled. And this market is that powerful, sometimes it doesn't even give a retrace into the fair value gap. It just taps the breaker and then runs. But entry inside of the breaker block, stop loss below the fair value gap, and then you're just targeting internal range liquidity. Also, the minimum risk to reward ratio that you should be aiming for every single trade is at least 1R. But again, you get your swing high down to the swing low of the liquidity sweep, looking around 50%, and you're looking for a swing high that is inside of a premium of the dealing range. But also let's check the higher 15-minute and the 5-minute to see if there's any unmitigated fair value gaps. Okay, nice. So there is a bearish ICT fair value gap on the 15-minute. Now, if we did actually target that 15-minute bearish gap, that is a negative risk to reward ratio. It's a 0.810. So I'm still going to target the premium side of the dealing range, but soon as we mitigate that higher time frame fair value gap on the 15-minute, that is where I will go break even on the trade. So if we play it out, so we've just mitigated the 15-minute gap right there. So that is exactly where I will be going break even. And then final TP would just simply be this internal range, or you can take a partial here and ride the rest to external range liquidity. So let's say in this case you are just holding a runner for external range liquidity, but TP1 is going to be this internal range buy side liquidity at the premium side of the dealing range. That's where you want to be closing ideally 80% of your position off there. Okay, and boom, TP1 smash. That's where you want to be closing 80% off there. And by this point, you must P break even to protect those profits. And then eventually price comes back down and stops you out at break even after you've either closed in full profit, if you chose to close in full, or stopped after taking partial profits. Either way, you have taken money out of the market using this model, which is the main thing. But notice how as soon as price gets back from a discount back into a premium, taking out this buy side liquidity, notice how it gives a reaction from that price. So always target the opposing side of the dealing range. Simply the closest swing high that you can find inside of a premium side of the dealing range for longs, or the closest low to 50% of the dealing range inside of a discount for shorts. But now that I've shown you guys two long examples, I will show you guys a couple short examples. Okay, nice. So I found a short example. So step number one, you want to see a sweep on buy side liquidity. You get that right here. Step number two, you want to see a displacement away from that liquidity sweep and causes a bearish market structure shift for shorts. That's what you get right here. As soon as price breaks below this low, ideally with a body close, it's not a must, but it is preferred. Then we need to see the ICT bearish fair value gap, which is what we get right here. And then lastly, we need to see the ICT breaker block, which would be this down close candle right here that takes out the sell side liquidity, gets broken below and retested as resistance. Again, it's simply just an old bullish order block that gets flipped and sort of used as resistance. So again, in this scenario, the breaker block is lower than the fair value gap for short, so I'm simply going to go short inside of the breaker block. Stop loss is just going to be beyond the fair value gap, or in this case the swing high of the displacement leg. And then you just simply want to target the opposing side of the dealing range. Again, if we get the swing low of the dealing range up to the swing high, get 50% on the closest swing low inside of a discount. That is ideally where you want to be, at least taking partials for first take profit or even full take profit. It's just whatever you prefer. But first, let's check the 15-minute and the 5-minute to see if there is any higher time frame opposing imbalances that come before 50% of the dealing range. So on the 15-minute, as you can see, we have an unmitigated 15-minute bullish fair value gap that is opposing our short idea. So simply what you would do here is either close fully as soon as price retests that 15-minute bullish gap, or at least close 80% off of your position, set your stop loss to break even, and then hold a runner for full TP, which would be the internal range discount liquidity or sell side liquidity inside of a discount. So I've marked out the high of that 15-minute bullish fair value gap, and that is exactly where the swing low is sitting. So as soon as price tags that swing low, I'm at least closing 80% off of my position right there. So just play a price out and see. Okay, right there, that's where you want to be, closing at least 80% or even full TP and setting your stop loss to break even. And then you just want to be holding a runner back to a discount side of the dealing range, which would be this swing low. And then boom, final TP would have been smashed on this trade, securing maybe it's around 3, or just goes to show you guys how much risk to reward ratio that you can pull out of the model when it does actually run. But if you can consistently combine a high win rate and a high risk to reward ratio with this model, even if it's just a 2 or even 1.5 or with like say a 60% win rate, that is a significantly profitable edge, because first of all, you have more winning trades than losing trades, and second of all, the winning trades actually outweigh all of the losing trades. So yeah, perfect model to have a clean edge with in the markets. But I go live Monday to Friday trading this exact model every single day with the VIP team inside of the VIP Discord. So if that's something that you're interested in, I'll put the link inside of the description of the video. And if you want to take it to that next level, I do offer a one-to-one mentorship, but it's application only. I will put the link in the description for that as well if you are interested. And for the one-to-one, I do have 3 more seats left to be taken for the remainder of January. And the reason why I do only pick just a handful of one-to-one clients is simply because I want to give you guys as much quality time as possible and give you guys just the best transformation. But again, if that's something that you are interested in, I'll drop the link in the description to apply. And if you do get accepted, within 48 hours you will receive a message from me personally on Instagram or via mobile phone. But yeah guys, that wraps it up for this video. If there's any other videos that you guys recommend me do, then please drop it inside of the comment section, and I'll see you lot all inside of the next video.